There we go. Hello, everyone, and welcome to another Alto Trading Live strategy session. My name is Richard Van Rich, here with Jeff Tompkins. Got Craig Ward in the chat. We're doing a very special in-between holiday edition. We'll see how many people show up for this. We had a lot of folks out on vacation, a lot of guys traveling, all that good stuff. So we're really glad to have you guys with us tonight. You'll notice your microphones are muted. That's so that you can hear Jeff and I talk. There is a Q&A box, so if you have any questions, put those in the Q&A box throughout the evening. We'll get to those throughout the event and also at the end. And if you have any questions about your account, any questions about technical issues, anything like that with platforms, just email support@altostrading.com and we'll get to those tomorrow. Before I bring on Jeff, let me just read this disclaimer. Trading securities and options involves risk. Prior to buying and selling an option, investor must receive a copy characteristics and standardized options. Investors need a broker to trade securities, and options must meet suitability requirements. Past results are not necessarily indicative of future performance. The performance figures are based on actual trades, including real money results. Due to the time-critical nature of trading, broker fees, and activity of other subscribers, there's no guarantee the subscribers will mirror our performance, and performance numbers shown are based on trades users could enter based on the trade signals. All right. With that being said, let me bring on Jeff. Jeff, you there?
Hey, yeah. Can you hear me?
Yeah, I can hear you. I can hear you.
Hey.
You know, I was thinking, like, the more we do these, we need like one of those like rock star riders, you know, where they have like backstage. I was telling my wife, like, next week I want to have like some herbal tea and like a shot of whiskey and like 14 yellow M&Ms.
I love it. I love it. Those weird requests. Yeah. I once heard there was some band that asked the crew to like take out all the M&M colors except for the green ones. So that's
I think it was Van Halen.
Yeah, that sounds right.
Yeah.
Crazy. I'm a little more simple. I'll just, take my Skittles and have that. I don't need any crazy stuff. So
man, Skittles are like crack, man. Those things are like so sugary. I eat like 5 Skittles, man. I'm wired all night. It's like matcha tea.
Right. Robert says, "Nice beard, Richard. Wish I could grow one of those."
It's prosthetic.
Yeah, I love it.
It's a fake.
So wearing your Halloween costume.
That's right.
Welcome everybody. Great to have you guys on, especially over a holiday week. Thanks everybody for joining. It's a pleasure to have you. So we'll go over some really great stuff tonight. It's a great time to be on with wrapping up the year in the markets and looking ahead to what's to come in 2022. So we have some really great stuff to go over tonight. We'll start out with our market overview, map out our levels on our charts, and we'll look at VIX correlations and signals as well as it relates to the markets. There's actually, the VIX has been a very valuable tool for helping us time these market continuations in the midst of some degree of correction or sell-off. So we want to make sure that we're looking at that, and I'll kind of show you what I'm looking at as it relates to the VIX. We'll look at our different sectors. We'll kind of focus in on what's currently overperforming and what's underperforming to help hone in on opportunities in the markets. We're going to focus tonight on selling option premium. A lot of our members are option sellers, including myself. It's a great way to collect income in your trading account. So this is one of my core strategies, and we're going to focus on that tonight. As always, we'll wrap up with Q&A. But as Richard mentioned, if you guys have questions, please put those in the chat box, or sorry, the Q&A box. It's easier for to monitor those in Q&A. So that would be very helpful. And we will go ahead and get started. So I'm gonna turn my camera off here so it doesn't get in your way, because we're going to be looking at our charts here. So let me go ahead and turn that off. Okay.
There we go. And I don't know if I forgot to mention, Craig is in the chat too. So Craig's out there, stayed up with us.
Got Craig here as well. Good. Okay, fantastic. So hopefully you guys, can you see my screen, Richard?
Yeah, see your screen and no boxes, so we're good.
Okay, good. All right, so let's take a look at what's going on in the major indices, and let's actually get this out of here. clean up the chart a little bit. All right, so looking at the S&P, we obviously had a big run up over the past 5 days or so. Nice little Christmas rally, and not unusual to see this. We've also seen a bit of a double V pattern here from a low in early December and another the double bottom a couple weeks later, which coincides with a previous resistance area. So let's start out by mapping that, and then we'll look a little bit deeper into what's going on for the rest of the year, and even into 2022. I think it's going to be an interesting year. Heard a lot of analysts projecting a continuation of the bull market next year. Things like interest rates and those types of things are going to really impact how that plays out, as well as some uncertainties with COVID variants and vaccinations and things. Let me get there we go, drawing tool out. All right, so this 45.25 level, well, let's actually start out with 4,500 because it's a half millennium mark. That one is the low from, again, back in early December. And then looking at 45.50, we kind of have more of a zone here because that was the high from back at the beginning of September before we had that sell-off in the month of September. And then we had kind of a false break of that support level in around the third week of December. And then we've taken off from there. And we broke through the previous all-time high yesterday, closed above it. And we'll just mark that at the half century mark, 47.50. And this, I was completely expecting this today. When we post the new all-time high on an index like the S&P, we often see some degree of stall or retracement, and we got that today. This, as long as this 47.50 level holds, particularly through the end of this week as we wrap up 2021, I think that has bullish implications for the beginning of 2022. So we want to make sure we're really monitoring this 47.50 level so that if it does hold, we can be positioned to take advantage of a continuation of the uptrend. If it breaks, that's going to provide more bearish sentiment that we'll want to take warning of. So basically what we're looking at here is a retest of 47.50 and a continuation of the trend to new highs. So I think the key takeaway here is not to get trapped in this in these breakouts, and when we hit new all-time highs in the market. You don't want to jump in on these too early because they often fake people out. If you can stick with it and stay in and you're okay with getting in at a bit of a higher price and holding a tight stop below support, that's one way to play it. But I prefer to wait for the breakout to happen, see if it holds. It just requires a little bit more patience, but see if that holds and then comes back down to retest this support level. It's a strong one, half century mark with 3 strong touch points, a breakout. So if we see this pullback and then a resumption of the uptrend, that's our indication that we are likely to post more new highs in the S&P. So interesting structure here. And the other thing that I want to point out is when you see this, let me clear these out. When you see this type of formation, and we see this so often in volatile markets, it's when it plays out the way that it just has, it generally follows through with bullishness. So it's a double V pattern or a double bottom. referred to kind of with different terminology, but when you see this type of double V and then a break of the resistance area, which was right here, this is quite bullish. And you can go back, to other market sells. We actually saw one right here. So very similar. See, we get this double V pattern. So we can use this as a prior example. So see how that looks similar to this. And then when you get the breakout here at this level, that's where you often see a big move in the market. So see how that looks very similar to the structure here that we're looking at. I mean, it's almost identical, because if you look at prior to the V pattern, see how we have this, that looks almost identical to that. See, I mean, that's
interesting.
Pictures, yeah, look almost identical.
I've heard some people say, like, when it does that, sometimes it'll, I don't know if it's true or not, but as you see the first W, then it goes up, and then it will do the same thing and go up just as far as it did before. Do you think that's possible, or can we hit like 5,000 or above?
Yeah, so like if you look at like the move that occurred on the second V, typically we'll see a similar magnitude move on a break of that resistance area. So see how these two lines are fairly similar in magnitude. If we hold this 4750 level, we'll probably see a similar. So 4,500, we're looking at a couple hundred points there. So we could see a couple hundred point move up into the 4950 level if this level holds and the pattern follows through like it did here. Yeah, so that's a good point. One other thing to note here too is if you look at the bottoms here, so this reversal here in mid-September was, we hit a lower low on the second V pattern down here. That's obviously still resulted in a bullish double V, but here is something interesting. So we hit a lower low, and then the second V was higher. So that's to me is even a more bullish indicator of a continuation of a move up in the S&P, especially now that we've broken this level. I think I said, or I think I saw somebody put in the Q&A, and we will look at that tonight, since we're going to focus on selling premium. Opening a spread below this support, like a vertical credit spread, and those can often be really good setups if you're not going to trade shares of the S&P or of the SPY.
I think that was Robert.
Yeah. Thanks, Robert. Yeah, that can be a great way to analyze these levels, and use them to your advantage to select your strikes for option selling premium strategies like credit spreads, or if we're looking at maybe individual equities or ETFs selling a put. So these can be great setups for those types of strategies.
Yeah, Shobo was asking me, if you see a retest of 4750, would you like to see a buy trade signal there?
Yeah, absolutely. So yeah, if we get a buy off that level, that would also be further confirmation, as well as a green cloud. So we don't have any divergence cloud right now. We've had, when it gets into a strong trend, we've seen our divergence cloud pop up on our S&P charts, but right now we're out of the cloud, probably just because we're in this more of a ranging pattern. But if this takes off, I suspect we'll see green divergence on our charts, and potentially a buy signal from trade trends. So yeah, definitely there. So that's the S&P. Any questions on that? We can look at the VIX. Actually, we'll look at the NASDAQ before we go to the VIX, but any questions there?
No, we're good. Move on.
Okay. So just looking at our gauges here real quick. So short, medium, long term, we've got, other than the NASDAQ, we did have a sort of a big tech sell-off to some degree today, which moved our short-term trend on the NASDAQ to sideways. But for the most part, we're looking at short, medium, long-term uptrends on all the major indices. Our volatility risk gauge is kind of right in between low and medium. So right now, risk is fairly low in the market. As far as trend, we're looking at more of a bullish trend. We're still a little bit in the yellow there, but I suspect if that level on the S&P holds and the market continues to go up this week or into 2022, we'll see that shift and become more bullish. Certainly, as far as our buy-sell ratio, we've got many more buy signals versus sell signals. So as far as the gauges are looking, we're looking pretty strong. We still have some underperformers. They're not real like drastic underperformers, but consumer discretionaries, communication, and financials are not doing real great right now. The three sectors that are doing well, if we're looking at opportunities within sectors, are utilities, consumer staples, and healthcare. So those are with utilities being number one, but a close second with consumer staples being our top performers. So those can be good opportunities to look for within the scanner. So yeah, let's take a look at the cues. So again, we had a bit more of a sell-off in the NASDAQ today. And I haven't checked the futures yet. They're probably somewhat flat, but let's go ahead and look at the level here, because what we're going to want to look for on the NASDAQ is for this 400 level to hold. Okay, so it held today despite the gap higher and close lower. But you can see here that we've had multiple touches. We also have a V pattern here. Double V. So similar picture to the S&P, with the exception that unlike the S&P, we didn't break the previous all-time high. So that one came in back here in mid-November. And we haven't gotten back above that level. So what we want to be watching is whether or not this support level holds. And so far today, it did. So tomorrow and into the remainder of the week, we want to watch for that to hold. Also, no divergence cloud at the moment, but we want to look for a retest and a move back up with the realization that we have another resistance level to keep an eye out for up here. Okay, so if this does break up, we're really going to want to look to see whether this serves as resistance. And if it does, we may kind of get stuck in a range on the NASDAQ. But if we can break out of this level, that would be very bullish. We could see a retest.
Yeah, NQ's up 50 points so far.
On the
little bit. On futures, yeah.
Yeah. And I suspect this level will hold just because it was such strong resistance, and we broke through with a lot of conviction yesterday. So again, no surprise that there was a bit of a stall of this breakout. But as long as this 400 level holds on the cues, I think that the structure is intact for a continuation of the move up here. Any questions there? And then we'll look at the VIX.
Robert just saying also a lower low on the W pattern on QQQ.
Mm-hmm. Yeah. But it did move up strongly off of that 3750 level, and similar again to the S&P where you see this. The resistance area was right around kind of 382, 382, 383. We had three false breakouts of that. So bulls are really pushing price up off that level, and it's moving strongly off there. Generally, when you see these double Vs, it's more probable that we'll see the index move higher versus coming back down here. And we didn't quite get that on the NASDAQ from back in September, October, like we did. It was more of a step pattern than a double V. So let's see here.
That's all I got.
All right, so let's take a look at the VIX. All right, so today the VIX closed at 1754. So we had a couple of VIX spikes, and for those of you who haven't attended past sessions about the VIX, when we get pending buy signals, that's the let me zoom in here, the white diamond you see. Let's see here. So this is our buy warning, and when it comes in below the 20 level on the VIX, that's where we want to, and that gave us a really nice warning of the recent sell-off, and triggered confirm buy confirmation here on the next day. That is where, we can use the VIX for portfolio insurance. If we've got long positions in the market, or we want to take advantage of a volatility spike, we can use the VIX to play that. What I do is I sell call options on the VIX on these volatility spikes. So like when we, but another way to do is you could buy a call when it's below 20 as well on these signals. They often turn out very great. So like here we're down below 20, we get the buy warning. At the time, the buy entry would have been above that candle, got triggered, and then we get a spike up into the 35 level. Those can be great plays to just buy a call on the VIX, or set up a vertical call debit spread. But since we're going to be focusing on selling premium today, I'll talk a little bit about what I do is I look for these spikes, and when we get up into above the 25 level, I like to look to sell call premium, because the VIX always comes back down. It's a bit like selling a put on an equity. Selling a naked call is not, while it does carry a potentially a large degree of risk if you're over leveraging, like back in March of last year where the VIX spiked up nearly to 90. Selling a naked call on that could do some serious temporary damage if you're not managing, position size and risk well. So often what I'll do is I'll look to start selling calls above the 25 level, and especially if I see a rejection off, like a rejection candle like this one, and then I'll start scaling in. So if the VIX continues to spike, I might sell one at the 35 or the 30 level, or even the 25 level. But if it continues to spike, I might sell, another couple contracts up if it reaches the 40 level. So I've got, this plan to scale in to short call positions. So I'm selling premium with the anticipation that the VIX, volatility will always get reined back in. It always decreases. So it's a core strategy of mine is selling calls on the VIX for premium income. So that's one way that I do that. And these are some of the levels that I use. 25. So again, would have been a nice place to sell a call. And of course, as the VIX drops and volatility contracts, then we capture some really nice premium for doing that. And we'll look at the call premium, but we're back in low volatility conditions, which, as we look at the VIX in the context of the indices like the S&P, this is a good indicator of whether the S&P will continue moving up, or we may be at risk of another sell-off. So our base has kind of been down here around the 15 level. So we may see the VIX come back down to 15, but what we want to watch is any move back above 20. If that occurs, then we want to look, number one, to see if we get any pending buy signals from the trade trend indicator. And we want to see if we get a VIX spike. So any questions on the VIX, and then we can kind of look at, to how to, right now the premium's low. I generally don't like, I will sell calls when the VIX is below 20, but I don't like to sell a VIX call below 20. That's kind of my cap. So I kind of look at the premium, see what's available, and then, decide if it makes sense. But we can look at kind of what that looks like in the platform.
Yeah, it's pretty much the only questions I have are about execution. So people want to know how many days expiration. Do you trade more than just the VIX whenever you're buying calls or puts?
Yeah. Yeah. So remember, good question. So remember the VIX, is basically a measure of volatility on S&P 500 options going out 30 days. This is going to be a short-term premium selling strategy. And the way that I structure it, let me get out of the charting here, is by selling short-term VIX options. So I go out, I typically, so they expire Wednesday morning. So I typically will sell a new call option on Wednesday morning, because I have these expiring that morning at the open. So that's when they're settled, but really they expire on Tuesday at the close. So keep that in mind if you do sell premium on the VIX. So like today's Tuesday. So tomorrow morning, I potentially look at selling the next week's expiration. So that'd be the Jan 5 calls. So again, with the VIX being below 20, our premium is going to be a little bit lower, but that can be okay. I generally don't want to sell below 20, maybe 19, sometimes maybe 18, but really I want to try to stick with 20. So tomorrow morning I'm probably going to be looking at the 20 calls and see how the premium looks on those. Right now, at the mid price, we're sitting at $1. And I go pretty small on these things because it's kind of like a lot of base hits add up to a lot of runs, versus just trying to hit a home run right in the beginning. Because if the VIX does spike, I want to be prepared to scale in at higher levels, like I showed you, like at 25, 30, 35, 40. And so I may end up with, let's just say I start with 2, I may end up with 10 contracts on a VIX spike, or I may just sell the 2 contracts. And I'm just using this as an example. And there's going to be weeks where I might just collect a little bit of premium. But the nice thing is I don't really care if the VIX spikes, because I'm giving myself plenty of room to adjust if it does. And I actually like when it spikes, because when it does, then I can sell really expensive premium. So when the VIX goes up, the premiums get really juicy. You can see, when you're getting in the money a few points, you're looking at $600-700 a contract. Once you're scaling up into these, I just scaled up into that recent VIX spike, and I don't know, I don't remember exactly, but collected like $5 or $6 grand just by scaling up as the VIX went up and then riding it back down. So the key is obviously to start small, be prepared for a spike, and then scale in, and then be able to ride it and adjust. So since I'm only going out a week in expiration, if by January 5th the VIX is trading above 20, I'm going to have to adjust this position and roll it out to the next week. And that's how I manage these. So if one of these ends up in the money at expiration, I simply roll it out to the next week. And depending on how far it is in the money, I may just leave that as is and roll it, because I'll collect a little bit extra premium for for extending the expiration by rolling it out to the following week. Just depending on the structure of the VIX and whether it's coming back down, I may even expand the position. So I might add additional contracts at a higher premium, because remember, if these calls end up in the money, they're going to be going for at the next week's expiration, they're going to be going for much more than $1 a contract. So it's an opportunity to add contracts to the position at a higher VIX level. Or I may also add additional legs. So I may add to the 20 strike position, but I might also add, depending on how far the VIX spikes up. Let's say it spikes up to 30, I might add a 30 call or a couple 30 calls. So it's a great strategy for me to be flexible, adjust, and have a very high probability of making money. I virtually never lose money with this strategy because I have the ability to adjust it and be patient and wait for volatility to come back down. So this is one of my core option selling strategies, is selling calls on the VIX. Sometimes I will sell puts on the VIX, but not often. If it does get down, into the 15 level, if it bases, I might look, but you can see, put premium on the VIX is generally not very good. It's kind of the opposite of what you'd see on most other securities, where put premium tends to be the juicier premium, but because of the way the VIX works, it's the call premium that's better. But sometimes, like, the 18 strike now, which is slightly in the money, the midpoint on these is right about 40. So since we do base at 15, it's pretty rare to go much below that. There's, on rare occasions, I'll look at selling puts on the VIX, but generally, I mean, it's rare. Generally, I'll use the call contracts on those. Any questions on that?
A handful of questions. One of them is, like, if they're not comfortable, say, trading selling a naked call, could they do like a call spread, like a credit spread?
You can do call spreads. The problem, though, is if you have to manage it and adjust it, it becomes a little more tricky with the long leg and the spread. If we do call spreads, so if we're selling call spreads on the VIX, the best way I've found to manage those is to start small. You're going to collect a lot less premium. I mean, let's say you sold we went out to next week's expiration and we sold a vertical call spread. And let's say we did 2 points wide on that. Our midpoint is 35. So instead of $1, we're looking at 35. So it's about a third of the credit you would get for selling a naked call, which is fine. But how most people mistreat credit spreads is it's basically a tool for people to over leverage their accounts. So just because you're hedging your spread doesn't mean you should over leverage it, and that's generally what most people do with credit spreads. So as long as you can keep your contracts within a reasonable amount, to where if things go wrong and the VIX spikes and your spread ends up in the money, you can adjust this by adding contracts. Because most of the time, the way volatility works, if you sell a call spread on the VIX spikes and then starts to come back down, it's going to be hard to roll this at an equal number of contracts and get a net credit. So you'll probably still end up with a losing position if you simply roll this and don't adjust the number of contracts. So the way to do that is to start out small, within a relatively small amount, to where you still have plenty of capital in your account to scale up the contracts, because that's most likely what's going to be required. So like if you were to start with 10, you might have to scale up to 20 or 30 or maybe even 40 contracts on a spike in order to capture a net credit, so that when the VIX volatility gets reined back in and the VIX comes down, you can take advantage of that. So generally a spread is going to require adding to the position at that strike, at the strikes that you set up initially.
Nice.
And you can certainly sell spreads up at higher strikes as well, just like I demonstrated with selling a put. So you can add to the position on the spike at different strikes, at higher call strikes, but you're probably still going to need to manage the in the money spread that you initially set up by increasing the number of contracts based on the way the volatility works.
Gotcha. And did you say it earlier that how many days expiration you typically do?
Yeah, I generally go out a week. So like I'll Wednesday mornings I'll open up. If it makes sense. I don't sell one every single Wednesday. Right now with the VIX being as low as it is, I'm gonna have to see where it opens up tomorrow. If it gets too low, selling it, because again, I don't like to sell strikes below 20 on the VIX. If it gets too low and the premium doesn't look at the 20 strike contracts, then I might sit out that week and not sell any. But when I do sell them, I go out to the next week's expiration. And again, remember the weekly VIX contracts expire every Wednesday morning. Again, just to reiterate, you're not going to be able to close these out Wednesday morning. They're AM settled. One mistake people will make on AM settled contracts is they will keep a position might be looking great the night before, the day before when the market closes. And they think it's going to expire in their favor the next morning. And then something happens and their, VIX spikes up and then you can't do anything. It's because it's AM settled Wednesday morning. So you're not going to be able to do anything with that position. So out of abundance of caution, even if, my contracts are looking good, but there's a potential, the VIX could spike above my strike the next morning. I'll just go ahead and close it out Tuesday before the market closes, being that these are AM settled. But most of the time, I just, I'm able to keep them open through expiration.
Gotcha. And Ed's wondering, do you always do the VIX or do you ever do the VXX?
No, not the VXX, just the VIX.
Okay.
Yeah. So yeah, the VXX doesn't work the same way. It's an ETN. Let me go further out here. This one is a bit different. It doesn't, well, number one, like it'll split and stuff, but let's get. But it doesn't work the same way as like is the actual VIX, the VIX. It's not necessarily going to come back down as easily. So the pricing on it is completely different. So it's not as favorable for selling call premium.
Okay, gotcha.
Here, like on the spike last year, I mean, before that spike occurred, the VXX was down at 52.50. It took a long time for that. Didn't even come back down to that below that level for the rest of 2020. Whereas if you look at the VIX, it's obviously come down below the 20 level and stayed there quite a bit. So yeah, just different pricing, behaves a little differently, but what you'll want to know is the VXX is an ETN. It's not, it's made up of different, a different structure. It uses like futures contracts and things to, so it's kind of like an ETF a little bit, but definitely a derivative of the VIX and not the VIX itself. So I like to just stick with the actual VIX.
Sweet, that's all I got.
Yeah, and you can see here, see how what we were looking at on the VXX, but the VIX, the VIX came back down to the 20 level and a little below that year. Then we actually hovered below, let me go back to below 20 for quite a while this year. So the VIX always comes back down. Even when we get a dramatic spike like we did last March up into the 90 level, it still always comes back down. So as long as you can use good money management, good risk control, good position management with scaling and rolling. It's again one of my core strategies. It can be a really profitable strategy. It just requires flexibility, patience, and good management, like so many strategies do, right? So I wanted to look at that. I want to look at the VIX and share that with you guys in terms of option selling strategies on the VIX. So from here, I thought we could open it up and to the group and see if there's anything the group wants to look at. We can potentially look at option selling strategies on those suggestions. Does anyone have anything they want to look at?
Let's see.
You guys want to just type some tickers in the chat? We can look at some different opportunities for option selling. And generally with option selling, we're looking at either a put or a vertical call spread. There's other selling strategies, obviously, calendars and ratio spreads and stuff. But I generally don't get too complex with my selling strategies. Like to kind of keep them within the same expiration.
It's like Stacy was quick on the draw. Stacy wanted to know, can you talk just before you get into that, talk a little bit what the Divergence cloud indicates and how to use it?
Yeah, so so the Divergence cloud, and let me not use the VIX because we're not going to see it very well there. If we just go back to the NASDAQ. So with the Divergence cloud, we're looking at divergence between momentum and price. So what the cloud is telling us is that when it appears green, there's a higher likelihood that price is going to go into a strong uptrend. And even within the cloud, there may be periods of significant pullbacks. So that's, it shouldn't be used as a sole tool for determining. But certainly if you're looking for opportunities within pullbacks, or what we like to look for are buy signals within green clouds or sell signals within red clouds. Those can be great opportunities. Or if you're more of a buy and hold investor, and you can ride out some of these trends, the cloud can be a good indicator of those. So typically when you see a green cloud, you're going to get stronger uptrends. And see how here it may be a little hard to see, but we were in a very strong uptrend in this green cloud, but then it shifted to red. Actually, it shifted pretty much right at the top of the market here in September of 2020. Got a little red cloud there, and then it went back. And same here. So see, we're in a red cloud. And so I want to look for sell signals like this one here. And then green clouds, I want to look for buys. And we got a bunch in this one. This is back in 2019. But basically it's telling us that you're more likely to see stronger moves, and that would be to the upside in a green cloud and to the downside in a red cloud. So it's kind of a confirmation tool. I use it as a confirmation if I'm looking for short opportunities on a pullback. So like, for instance, in this red cloud back in 2018, we get these large legs down and then we get a retracement. That's where I would be looking for entry opportunities within the cloud as we retrace. And then when we're not in a cloud, like right now, generally we shouldn't expect to see as strong of trends. So right now, we're not in a cloud. And this is actually interesting. This is a fairly parabolic move off of this low back at the beginning of October. And we didn't get a green cloud. And then price has now gone into a bit of a range. But I think if we break out of this and we do get a green cloud, that's going to also give us extra confirmation of a potential continuation of the bullish trend in the market.
All right, cool. Could you look at Goldman Sachs, GS?
Yeah. All right, so we got a red, it's a little faint. I don't know how well you guys can see that, but we are in a red cloud, and we've gotten some sell signals here on GS. So it's looking a bit bearish. So for premium selling strategies, we could look at a bear call spread at a resistance level on this one. So I might be looking at, looking for a strong level of resistance and then checking premiums near or past that level for setting up like a bear call spread. So like the 404 level, I'm seeing some significant resistance here. So we got multiple touch points at that level. Also at a bit lower, you see this. So we've got a couple levels of strong resistance here, and we've got a bunch of touch points at this one, and we rejected that level today. So I'd be looking at, if I could get a bear call spread, ideally above this 404. We may not be able to get good premiums on that. I'll go over and look in the chain, but 392 to 404 is our resistance range. So especially if we move off, continue to sell off from this 392 level, we may be able to get into a good bear call spread. Let's take a look at what the premiums look like, that 392 to 404 level, if we can get anything good. Oh, let me clear out my drawings. Okay, so we look at the options. Generally, when I'm selling a vertical spread, I try to stay within 30 days of expiration. I generally start looking about 2 to 3 weeks out. If I can't get good premium and I feel like the level's strong enough, I might go out a little bit further, but I don't want to go past 30 days. So generally I'll start kind of looking right here. This is 17 days until expiration at the January 14th expiry. Let's see here. And the reason for that is obviously you get more time decay within the final 30 days of the life cycle of the option. And I don't like to, other than what I demonstrated on the VIX and some of my put selling strategies, I don't like to go too short in expiration, because you get what's called gamma risk. Basically, these shorter dated options are going to be more sensitive to changes in the underlying, the price of the underlying security. So if you sell a near dated option, it's going to be impacted by a strong move in the underlying security much more than a longer dated option. So generally kind of the sweet spot for me is 15 to 30 days. So we identified that 392 and 404. And actually, we can get above both of those strikes going out to the January 14th. At the 405 strike, we've got an 81.2% chance of those expiring out of the money. In other words, Goldman Sachs finishing below 405 by January 14th. So let's see what kind of credit we would be able to get on these. And these are 5 points wide. It's not terrible. The midpoint credit is 75. I would have liked to see it more closer to like $1. Unfortunately, the next strike lower is 402.50, so it's not above that 404 level. But not terrible. Let's see what we could get if we went out to the Jan 21 at the 405. Yeah, so if we're willing to go at it another week, but we're looking at 24 days till expiration, midpoint credits above a buck on that on a 5-point wide spread. So that's a little bit better. So this is kind of how I analyze whether I like to, on a 5-point wide spread, I want to get at least $1 in credit to justify the risk. on that one, but that one was a good example. That one looks like a good opportunity for a bear credit spread. Any other suggestions?
I had a good question. He's saying when the divergence cloud and trade trend are in agreement, say they're both, you got a buy signal, then you've got a green divergence cloud, and you want to go take a long symbol. Is there any sort of max premium you want to pay? And when you do that, what kind of strike price would you look at? Would you look at the money, in the money, out the money?
So what strategy are we talking about? Like selling a put or?
Basically just like going with long options, maybe just buying calls.
Oh, okay. Oh, okay. Buying options.
Or like, yeah.
Okay, yeah. So
or even selling a spread.
Yeah, I mean, there's all kinds of things, everyone's kind of got an opinion about how much to pay for, whether you're overpaying for an option or not. And there's all kinds of formulas out there. And what I generally, want to look at is implied volatility. So for that security to tell me, is the implied volatility, which is relative. Let me see if I can get it on here. Let's see. I think ours just has historical. Yeah. Let me show it on. So because volatility is, specific to the security, so you can't like relate the volatility of one stock to another. I really want to be looking at, I guess I already had it on there. Oops. I want to be looking at the volatility over like the past year on that security. So like, we'll just stick with Goldman Sachs as an example. If I were looking, and that's a great question that Ed asked, because we always want to know, like, does it make more sense to, use a long option strategy, like buying calls or doing a vertical call debit spread, or to sell premium? Because the rule of thumb is you want to sell premium when volatility is high, and you want to buy it when volatility is low. So the best way to do that is just use implied volatility for the security you're looking at trading options on. So we're looking at, going back a year, the volatility of Goldman Sachs. So generally when it's, down here in this 26, and this is why I say, these numbers are not going to be applicable to, if we went to another stock like Apple or, Amazon, or every security is different. But on Goldman Sachs, low volatility is around the 25 level, right? So when it's down here, we know that option premium is inexpensive, and it may make more sense. So like as Ed mentioned, when we've got like a green divergence cloud and a buy signal from trade trend, and we see that volatility is low, it would make more sense to buy a call or buy a call spread than it would be probably to sell a put. And that was the case here. Recently volatility spiked, and it has come down a bit, but it's still fairly high. It's kind of more in the mid range. So as we just looked at an example of selling a bear call spread on Goldman Sachs, that made sense, right? The premiums are still, going to be fairly good. But if volatility comes back down, and we get a buy signal in a green divergence cloud, then it might make more sense to obviously to buy.
Cool. Yeah, Ed's saying that the year look back was very, very helpful to him.
Yeah. A lot of people make the mistake of like cross comparing volatility. But again, like if you look at implied volatility across different stocks, you're going to see that the numbers don't match up, and it doesn't matter anyway. You really want to know what the volatility of that security is to help determine whether the premiums. So for me, it's kind of more of like an art than a science, even though there are formulas out there that will tell you that the premium's too expensive or not. I like to keep things simple and just visually look at this. I can tell you that Goldman Sachs premium is kind of in the mid range for what it has been historically. And I don't need to like do any fancy calculations to tell me if, I'd be overpaying for buying an option or, getting underpaid for selling an option. So that's kind of how I do that.
Cool. That's all the questions I got, really.
All right. No other tickers we want to look at or anything?
How about Adobe?
Adobe. All
It
right.
came up earlier.
Yeah. So, man, Adobe's been really volatile lately. Some really strong moves here. This prior move up. Whoa, that was it. So we got some good buy signals. The last really good one came in. Well, we got one back in March, then another good one in June. So Adobe was down just under 500. It's gone up to 700. So really nice move there. Green cloud got some nice buy signals. We shifted to a red cloud here. Actually got a really nice sell signal. So we've got trade trend seems to work really nicely on Adobe. We've got a nice sell there, but we're in a red cloud again. Quite a dark red cloud. We got a sell signal, but there is some significant support down here around the 550 level on Adobe. So this might be more of a range play. I'd be looking to see whether this 550 level holds and we move up out of that, or and in this case, this could be kind of more of a range play, and potentially, if we were to get into back into the mid range here between the peak and the trough, so kind of right in this 630 level, just eyeballing it. These can be, in terms of selling option premium, good iron condor setups, because we've got well-defined support and resistance, and if we can find strikes that make sense above resistance and below support, so above for a bear call spread and below for a bull put spread, we can double up on our premium, and these can sometimes make good iron condor opportunities. So I'm glad we looked at this one. This could potentially be an iron condor setup, but I would wait to see if this level holds and we get back up into the 620, 630 range. So then we'll be kind of right in between or in the middle of this peak to trough move, which is kind of defining the range here on Adobe. But definitely making a lot of really big moves at the moment. So
Got a couple others.
I was actually, let me look at the stats real quick on this one. I'm just kind of curious. Okay. Yeah, so overall, it's got a good profit factor. This is going back 5 years for all the trade trend signals. Profit factor above 1, so it indicates it's profitable. The trade trend signals, that is. Seems like obviously the long trades are doing much better than short. Our short trade profit factor is below 1, but our longs above 2. So that's really where the profit factor benefits coming in on long trades on Adobe. So and then looking at cyclicality, it looks like if we just look at long trades, Mondays, that's long trades only. Mondays, Wednesdays, and Thursdays are the day to trade those. So this is our statistical tool that we use within Zillion to analyze cyclicality and better days to trade the security, as well as looking at profit factor and things like that. So yeah, let's go ahead and take. We're kind of coming up on the hour, but let's take one more, and then we'll go ahead and wrap it up.
Okay, let's do see if you got it. WTER.
WTER. Alkaline water.
This is Moshe's.
I think my wife drinks alkaline water.
I does too.
Okay, WTER. I'm not real familiar with this name. Looks like a low dollar volatile stock. Yeah, so I generally stay away from these, so-called penny stocks, but obviously they can make some pretty significant moves. So just looking at the signals, I'd be curious to look at the stats on this one as well. We did get a buy on this name back in at the beginning of June with a confirmed trigger. That's when it was trading around $1.25. So didn't quite get a double, but almost doubled there. We're currently in a red cloud on this one. No trade trend signals. There was a little buy signal. Worked out okay. Just a little bit of a positive mood there, but big sell off on this one. In terms of support, looks like we do have a pretty good base around 120 on this one. And then a break of that level, we're looking at further support down around 90. Definitely a volatile stock. These are ones I tend to avoid, depending on what strategy I'm using. If I was somebody put a gun to my head and I had to trade this, I'd probably trade the shares directly. Wouldn't be looking at selling premium. I don't know if this is an optionable stock or not, but if it is, I wouldn't be looking to sell premium on a company like this, because if it fails, it could go down to zero and you'd lose it all. So,
Alrighty.
Let me look at the stats on this one real quick. I'm just kind of curious. So we're looking at aggressive. We do have it on WTER. It actually does have a positive profit factor. Looking at all the buy sell signals, 1.07 total, 1.13 on long trades, 1.02 on short. So it looks like the trade trend signals do pretty well on it. Looks like Mondays and Tuesdays are the day to avoid trading those. Wednesday, Thursday, Friday have historically shown the better performance. So I love this statistics tool. It really, and it even changes based on your mode. So whether you're aggressive, moderate, or conservative mode, you can look at that. Wow, if you're in conservative mode, Thursday is the day to trade that. There hasn't actually been only one trade, but pretty interesting. So, yeah, and guys, we do still have the early bird release available for Zillion. So if you guys want to go to zilliontree.com, I believe it. We still have it up, right, Richard? Yeah. So we're launching Zillion sometime early in 2022. So it's open to early bird release right now. If you want to get in on it at a 50%, and then you're grandfathered into that, no contracts or anything of that nature. But you're then grandfathered.
I'll put the link in the chat. It's the altostrading.com/Zillion. That was the one we were doing.
Yeah, so Richard will put that in the chat, but we are offering 50% off through the end of this week. And then the early bird will close down at the end of the week. And we haven't announced an official launch date in 2022. But if you're interested in getting in it at a 50% discounted rate, that's available. So Richard will put that in the chat for you guys. So excellent. Well, any final questions or anything, Richard, that came through that we want to happy New Year to you too, Shoba. Great to have you on. Thank you. Happy New Year to all of you guys. We won't see you probably until January 20. Let's see, we won't see you guys till 2022. So I hope everybody had a great Christmas and has a happy New Year celebration. But any other questions, Richard?
No, that's it.
All right. Well, thanks again, guys. Happy New Year. Thanks, Ed. Thanks, everybody, for your participation. Thanks, Jose, Robert, Greg, good to see you. All right, guys. Thanks so much, Robert. Yep, appreciate that. Thanks, Lily. So yeah, we'll see you guys all next. We're holding our next. Is it next Tuesday, Richard? We're holding our next one, right?
Yeah, next Tuesday.
We got next. Yeah, so we'll see you guys back next Tuesday. Hope you guys have a great rest of your week.